If you look at the demand and supply for gold this year, the demand picture is quite interesting. This year to date, a lot of central banks in Asia actually buy a lot of gold. Why is that so? I think it's actually a strategy. If you just look at why China has been buying so much gold recently, it's also because it's a bit of geopolitics involved. Keep in mind, if you just look at the news a couple of weeks back, a lot of people are saying, US dollar may not be relevant. A lot of people are moving away from the US dollar. They don't want the US dollar. They want to move to other currencies. So I believe that even US, China to some extent is using gold as a strategy. They don't want to buy US dollar or they don't want to hold US dollar, but in fact they are changing over to gold. This is a good thing because as long as central bank is buying, there's strong demand. So if you go back to economics, if there's strong demand and supply is fixed, normally that will support prices. So crucially, if you are watching the market, watch out on this central bank buying because it's going to be something that's going to support the market in the near term. Singapore has been aggressively buying gold as well as part of their central bank reserve. Turkey as well, but I think Turkey numbers has actually came down a bit because I think a lot of their residents is actually buying a lot of gold and the country itself is suffering from US dollar. So if that really happens, I think naturally, if countries are moving out of a common currency, besides currency, I think obviously they can look at gold. Now, if you compare gold with other asset classes, what is the relationship? One can clearly see is that if you compare gold with, say for example, with other commodities, there's not much of a co-relationship. In fact, there's actually no relationship between gold and other asset classes, especially the other commodities. How about with S&P 500? You can clearly see there's a small positive relationship, but that's very small. In fact, to a certain extent, the economy or when the index doesn't perform, when S&P 500 is on a downtrend, you tend to see gold prices to be stronger. Now, crude oil, funny thing is that, crude oil and gold is actually a slight negative relationship. That means high gold prices, normally you see lower crude oil prices. Because generally crude oil is related to more of the economic demand. Gold is more relevant to the economic risk. So if that economy is not doing well, people just buy gold. Chart you the gold chart as well as the Dow Jones index. You can clearly see when we have so-called financial crisis or any type of crisis, even the health crisis back in 2020, you can clearly see gold is the main beneficiary. So we have seen that in 2008 during the global financial crisis when S&P collapsed almost 35%. You can clearly see gold actually did a massive rally. Same thing happened again back in 2020 during the COVID-19 pandemic when Dow Jones actually plunged almost 45%. You can clearly see gold actually rally to all-time high. So gold in times of trouble, in times of economic trouble, I think gold perform its role as a hedge against all these economics issues. Talking about equities market, what I have in this chart is to show you the margin. We should trade a lot of equities investors in US, they use margin to buy shares. If you just look at the trend, when margin depth increases, normally the S&P 500 will also increase because people are getting financing from the banks to buy shares. Now, the problem with this is that when interest rates is high, it's close to 5%, this financing cost is going to be high. Normally, what the investors will do is that when interest rates are the cost of financing the interest rate is high, they have to sell their shares. They won't use the margin anymore. And therefore, you can see the market also soften. So I'm just showing you a bit of relationship here. Whenever you have increasing margin depth, that normally tells you the market is actually quite supportive in the near term. If you just look at VIX, VIX is basically an index that measures risk or fear. If you recall, during the early parts of the pandemic, VIX actually jumped to as high as 80 points. I think that was almost as matching the global financial crisis time. So when VIX is high, normally people are very fearful of the market. They will sell the S&P or the Dow Jones. Now, when VIX is very low, what this tells you is that the market is actually very comfortable. There's not much of a risk. The funny thing is that right now we are seeing VIX almost to a level indicating that potentially the economy is going to be smooth sailing. There will be no problem. So it's very difficult for VIX to have that kind of relationship in the sense that if we just base on looking at VIX to think of whenever VIX is high, you go into gold market. that kind of relationship is difficult to understand now, because VIX itself is actually made of the options in the S&P 500. And I think because of the options market is highly structured and highly complex, one can easily manipulate VIX numbers going for in the market. So in that sense, it gives you a false picture. So if you are trading the market, you think VIX, just by looking at VIX, you want to get a better gauge of the market. I think you need to accompany with other economic indicators as well. So right now, despite VIX is showing you that the market is complacent, that there will be no problem, but what you're seeing in the index is not any sign of strength, but in fact a lot of weaknesses. So this is where you need to be careful if you are trading based on a VIX index or VIX measurement. So when this happens, where one have to focus a lot of attention to what asset classes benefits most in a weak economic situation. When you have inverted yield, that means you have the near-term yield, your 2 years treasury is performing higher than your 10 years treasury, which is inverted. Normally this situation tells you it only happens in a recession. Normally this situation of an inverted yield curve tells you that the economy is not doing well at all, and a lot of pressure is on the bond holders. I think despite all this, a lot of signs are pointing to you that the economy going in the next 6 months or so is going to get a bit jittery, or is going to get very volatile. So as long as this banking crisis is here to stay, now there's stock there's also other smaller banks are also in trouble. I think that will really put a lot of pressure into the economy, but ultimately this will benefit gold. A common indicator of an economy is doing well, just look at unemployment. There's a lot of unemployment that's happening around the tech sector. So again, all this is pointing to you weakness in the economy, and eventually this will have an impact on gold price. One of the common things that a lot of people miss is that one of the earliest weaknesses economy is to look at bankruptcy filing. This is crucial. I think US starting to appear, the bankruptcy filing for this year alone, year to date, is actually quite high. If you track historically speaking, every time when the economy enters a recession, in fact, every time when S&P 500 enter into weaknesses, you notice that gold is the one that performed very well. Over history, it has tested that every time when the economy going into a tough time, gold is the one that benefited. A lot of people say gold is a good asset class against inflation. I would say in certain ways it is, but in fact it's not only gold. You look at it, commodities itself is a very strong asset class to hedge against inflation. So if you just look at this chart, you have the red line, which is the US inflation, and you have the green line, which is the COMEX gold price. If you notice this, every time when inflation starts to pick up, you probably will see higher gold prices as well. Right now, the VIX is pointing to you there's no fear, so therefore, everything looks well. The funny thing is that if you compare VIX and gold prices, you can clearly see, despite VIX is almost at all-time low, but how come gold prices are at all-time high? This is basically to show you why US dollar is still quite dominant. Keep in mind, I think US dollar has been always the currency system of the world for a long period of time. For that to unwind, it takes years. So I think that's something for us not to be fearful in the near term. But it's good to watch out this development, because as long as US dollar loses its competitiveness, I think that will also affect other currencies. And in that sense, gold could be the ultimate beneficiary if that circumstances appear. So if a high interest rate environment is a high opportunity cost of holding gold. So many uncertainty, regardless whether interest rate is high, people will still go into the gold market. Every time the yellow line is showing you the dollar index, the blue line is showing you the gold prices. So whenever you see strong dollar index or stronger dollar, normally you see weaker gold prices. US Treasury yield tend to rise during high interest rate. So high interest rate will not benefit gold because of the interest rate element. So keep in mind, right now Treasury yield is starting to drop because people are expecting the US Federal Reserve to probably stop hiking interest rate in the next couple of months or so. As long as interest rates stop rising, I think that will give a weaker dollar, and eventually that will support gold prices. If a market is net positive, that means most of the participants are holding long. What it tells you, generally the market, people are bullish on the market. So right now you can clearly see that gold futures market right now, a lot of people are holding a positive position. That means they're still expecting gold prices to go higher. So it's a good indication. That means any sign of rally in the gold market, there is always what we call a seasonal pattern. if you notice one period or one particular period that is usually a period that where gold prices tend to be strong is normally is around July, or in fact year end. The December and January period is normally, you start to see prices of gold tend to do well.